Thank you, Taxmann, for providing me this opportunity to present this issues on restructuring of firms and LLPs. And thank you, everyone, and good evening, everyone joining today's evening. We would be discussing about the direct tax implications on restructuring of firms and LLPs in today's discussion. Now, let me just straight away discuss about the points which we would be discussing. We would be discussing about the taxability on retirement or reconstitution of firms and LLPs. So in this, we would be discussing about the new section, subsection 4 of section 45, which has been revamped since 2021. We would be discussing about the erstwhile section, subsection 4, which was modified. With section 45.4 being revamped in 2021, there was another section, section 9B, which was introduced into the Income Tax Act. We would be discussing about that. So in fact, we would be comparing the three sections. And with this, we would be discussing about the case studies to make the subject much more clearer for every one of us. Then secondly, we would be discussing about the conversion of company into LLP or firm into a company. So we would be discussing about the direct tax implications whenever this conversion takes place. We would be discussing about the rationale. Why would anybody want to convert a company into LLP or a firm into LLP? Then apart from this, we would be discussing about certain implications of certain other sections. Whenever any conversion is taking place, one would have to take those sections also into account. So we would be discussing that. The third part of this agenda or today's discussion is with regard to taxability of capital contribution by a partner in a firm or a LLP. So what are the implications of section 45 subsection 3 and what are the implications under section 56 to 10, which is there in income from other sources. So we would be discussing implication of these two sections whenever any capital is contributed by the partner to the firm or LLP. So basically, we in today's discussion, we have 3 points or 3 agenda points which we would be discussing. So roughly we have around an hour or so to discuss all these points. So what I have done is I have distributed a certain amount of time for which we would be discussing. Of course, the idea is to give an overview of these sections because in a span of 60 minutes, it is very difficult to touch upon in depth each and every of these points. So we would be discussing about this overview of all the 3 issues. Now let us start the taxability on retirement or reconstitution of firm or LLP. Now, as we all know that whenever there is any reconstitution or retirement of a partner in a firm or a reconstitution of a firm, there is applicability of section 45 subsection 4. And in fact, section 45 subsection 4 was there in the Income Tax Act. However, there was a revamping of this particular subsection taken place in White Finance Act 2021. And White Finance Act 2021, there are a lot of changes which have been done in this particular section. And with this, there was one more section which we would be discussing, or would be section 9B, which was also introduced, White Finance Act 2021 only. Now, when is section 45.4 is applicable, we would be discussing that. So section 45.4 starts with a non-obstant clause. So it starts with notwithstanding anything contained in subsection 1 of section 45. So it says that where a specified person receives during the previous year. So what we are discussing right now is the applicability of section 45.4, under what circumstances section 45.4 is applicable. Now, the first condition which has to be fulfilled is that a specified person should be receiving during the previous year. So there has to be a specified person. A specified person is defined under section 9b to be a partner. So essentially a partner of a firm or a LLP. If he receives during any previous year any money, capital asset, or both. So the second condition which needs to be fulfilled is the said specified person or the partner must be receiving either money, or he must be receiving a capital asset, or both, a combination of money and capital asset. If he would be receiving, then 45(4) would be applicable. And he would be receiving from whom? He would be receiving from a specified entity. Specified entity in this case is defined under section 9b to be a partnership firm or a LLP. So if a partner receives any money or capital asset, or a combination of money or capital asset from a firm, then 45(4) would be applicable. Now, this is very interesting that in this, since it is 45(4) is part of the head capital gains, so stock in trade is not there in this particular receipt. Stock in trade is covered separately under section 9b. This is one important aspect. Now, when the asset or capital asset or money would be received, so it would be received in connection with the reconstitution of such specified entity. And reconstitution of the specified entity has also been defined, which we would be discussing. Then whatever is the gain arising shall be chargeable to tax under the head capital gains. And this taxability would be in the hands of the partnership firm. So this is very interesting that the taxability will not be in the hands of the partner, but will be in the hands of the partnership firm. And there is a formula which has been given under section 45(4), which is A is equal to B plus C minus D. Of course, we would be discussing in detail the application of this formula along with the case studies. But right now, I'm just briefly touching upon the various aspects of subsection 4 of section 45. Now, what is A and B and C and D in this formula? A is the amount of capital gain which would be chargeable to tax under the head capital gains. As I mentioned, this capital gain would be chargeable to tax in the hands of the partnership firm and not the partner. Now, what is B? B is the value of money received by the specified person. So whatever value of money, if the specified person or the partner is receiving any money, this would be considered as B component of this formula. And if he is receiving any capital asset, then the fair market value of the capital asset would be considered as the C component of this formula. And what is to be reduced? The D is to be reduced. D is nothing but the balance in the capital account, which is represented in the books of accounts of the partnership firm. So this formula would be essential for us in discussing the taxability under section 45(4). Now, whenever there is any positive element, a positive outcome of this formula, then there would be taxability. If there is zero, if suppose A, the outcome of A ultimately is zero or is in negative, then it has to be ignored. There is no capital loss concept in this. Only the gains would be taxable. Now, in this particular formula, it has been specifically provided, and it has been provided by way of proviso that wherever there is any self-generated goodwill, that has to be ignored. Or in case if there is any revaluation of capital asset, and because of this revaluation, the balance in the capital account has been increased, that has to be ignored while considering this formula. So we would be discussing in further detail in the case studies. As I mentioned, there are certain definitions or certain aspects which have to be considered. This is first is reconstitution of a specified entity. Now, what all is considered or what all is included in reconstitution of the specified entity is there in section 9b, defined in section 9b. Then specified entity itself, that is the partnership firm, is defined in section 9b. Specified person, that is a partner, is also defined in section 9b. So section 45.4 also draws reference from certain definitions in 9b. I've already discussed that self-generated goodwill and self-generated assets that have to be ignored. These are nothing but those assets which have been acquired without incurring any cost of purchase. So if any amount has been expended to purchase these goodwill or self-generated assets, then it would be considered in the formula, otherwise it would be ignored. Now, the interesting point is that it has been clearly explained, and this is by way of an explanation, that there is one section 45.4, and there is also, as I mentioned, section 9b. Now, there was a lot of confusion whether section 45.4 will apply or section 9b would apply. Whether if section 45.4 applies, can there be simultaneous application of section 9b? So for that, it has been clarified that both the sections would work independently. So this is very important, and this has to be noted that once somebody calculates the capital gain as per section 45.4, one also has to look at the applicability of section 9b. And both the sections have to be independently applied. Now we briefly discuss about section 9b. Section 9b says that where any specified person, again, the specified person mentioned here is the partner, where any specified person receives during the previous year any capital asset or stock in trade or both. As I mentioned earlier, that section 45.4 was applicable when money or capital asset was received, or a combination of money and capital asset was received. Stock in trade was not included in section 45.4. But in section 9b, it only covers capital asset and stock in trade. Money is not covered in this, or cash component is not covered in this. Capital asset is there in section 45.4 as well as it is there in section 9b. So what is the applicability of section 9b? Section 9b is when a partner receives any capital asset or stock in trade, or a combination of capital asset or stock in trade from a partnership firm or a LLP. Specified entity, again, as we discussed in section 45.4, that a partnership firm or a LLP is a specified entity, and that has to be received in connection with the dissolution or reconstitution of such a specified entity. So what is the point of taxation? That it has to be either there is reconstitution of the partnership firm or dissolution of the partnership firm, then there would be applicability of section 9b. Now, it talks about both capital asset and stock in trade. So there would be taxability under the head capital gains as well as under the head PGBP, or profits and gains of business and profession. So one has to consider 9b properly, because if there is a capital asset which has been received by the partner, then there would be taxability under 45.4 as well and under section 9b. Whereas in case of stock in trade, there would be taxability under 9b, and it would be covered under the profits and gains of business and profession head. Now, for the purpose of calculating the gains arising out of section 9b, one has to consider the fair market value of the capital asset or stock in trade which has been received by the partner. Now, the fair market value here is not the 50C value which we normally take, or the circle rate, or the DLC value which we normally refer to. Fair market value here refers to the fair market value of the asset which is being transferred the capital asset or stock in trade which has been transferred, and for that the fair market value which is defined under subsection 22B of section 2 has to be considered. So this is a important. 45(4), or for that matter capital gains head, refers to the DLC value, whereas 9B does not refer to the DLC value or the circle rate, as we call it. It refers to the fair market value. Now, one may note that the fair market value can even be more than the DLC value, because fair market value can be the value for which a recent transaction has taken place. So a similar transaction has taken place. So this talks about the fair market value and not the DLC value. Now, there are other aspects also which I am not discussing right now. Straight away, what is reconstitution of a specified entity, or when is the trigger point for applicability of section 45(4) and section 9B is, as I mentioned, it is on the reconstitution of the specified entity. What is meant by reconstitution of a specified entity is clearly defined under section 9B. It says that one or more of partners and members of such specified entity ceases to be partner or member. So whenever there is a retirement, whenever the partners cease to be partners, then it would be considered as reconstitution of the firm. The second point is that one or more new partners or members are admitted. So if there is admission of a new partner, in such circumstances, one or more persons who are partners or members before the change continue as partners or members after the change. So whenever there is admission of new partners, it is considered as reconstitution. And in fact, if all the partners continue, but there is change in the profit sharing ratio amongst them, there is inter se change in the profit sharing ratio, then also it would be considered as a reconstitution of a specified entity. As I've been mentioning, that specified entity and specified persons are defined in 9B. Specified entity is nothing but the partnership firm. In fact, this particular section, as section 45(4), is also applicable in case of association of person or body of individuals. But we are not discussing for our discussion today, because we have to restrict it to the applicability on firms and LLPs only. So we are not discussing about AOPs and BOI, but otherwise we will restrict our discussion to specified entity being a partnership firm and specified person being a partner of that firm or an LLP. Now, we discussed about section 45(4), which was completely changed or revamped by Finance Act 2021, and also section 9B, which was inserted along with this in Finance Act 2021. Now there was erstwhile section 45(4). So we would briefly discuss about the differences between the erstwhile section 45(4) and the new section 45(4) and the newly inserted section 9B. First point of difference, in fact, it is not a point of difference, that which is the taxable entity under both the scenarios. In the pre-2021 position, when there was only section 45(4), the taxability was in the hands of the firm. Here also, after this amendment, the taxability is in the hands of the firm only. Then what is the point of taxation under the erstwhile section 45(4)? Whenever there was transfer of capital asset by way of distribution or dissolution or otherwise of the firm, then there was taxability under 45(4), the erstwhile 45(4). But in this today's scenario, after the amendment, as I have already discussed, the taxability arises when there is reconstitution of the firm. And in fact, if there is dissolution of the firm, then also the taxability arises. There is one major difference between the new 45(4) and section 9B, is that section 45(4) only talks about reconstitution of the firm. The point of taxation is only on the reconstitution of the firm, whereas in case of 9B, it talks about both reconstitution of the firm as well as dissolution of the firm. The year of taxability, the in the erstwhile section 45(4), it was on transfer of the capital asset, whereas in the newly amended provisions, it is when the asset, capital asset or stock in trade or money is received by the partner. Head of income, I have already discussed earlier. 45(4) was under that capital gains. The taxability was under that capital gains. Whereas the same is in the new section 45(4), the taxability again continues under that capital gains. Whereas in case of section 9B, there can be taxability arising both under the head capital gains as well as under the head profits and gains of business and profession. So if a capital asset has been given to the partner, then it is under that capital gains. And if a stock in trade is being given to the partner, of course, on dissolution and reconstitution of the firm, then the taxability arises under the head PGBP. Now, sale consideration for arriving at the gains, what would be the sale consideration? It is the fair market value of capital asset on the date of transfer, which was there under the erstwhile section 45(4). We've already discussed under the new section 45(4) and section 9B, the fair market value of that capital asset is to be considered, and the fair market value is defined under section 222B. The cost of acquisition was considered under the erstwhile section 45(4). In the new section 45(4), there is an entire formula which has been given, which is to be considered. And for section 9B, the cost of acquisition is to be considered in the case of capital asset. And there is an entire formula and entire guidance which has been provided. And in case a stock in trade is being transferred, then the cost of acquisition of that stock in trade is to be considered for calculating the gains. Then reduction from sale consideration due to capital gains taxation in the hands of the firm. This is very, very important change which has been brought about. And in fact, we would be discussing about this in greater detail. There is a concept of attribution which has been introduced, which was not there in the erstwhile section 45(4), but this has been newly introduced under the section 45(4), and for that an amendment has also been made under section 48, which talks about the computation of capital gain. So we would be discussing about that in detail. Then interplay between the provisions, section 45(4) in the erstwhile section 45(4), since there was no 9B at that point of time, so there was no interplay between the sections. 9B itself is a standalone section, but if we look at the new section 45(4), it draws reference to a lot of definitions which have been provided under section 9B. Then treatment of losses. In the erstwhile section 45(4), if at all there were any losses, they were admissible. Under 9B also they are admissible, but under section 45(4), as we mentioned, as we discussed in the start only, that if the formula, that is A is equal to B plus C minus D, there is a negative figure, then that would have to be ignored completely. Then definition, we have discussed cost of capital asset in the hands of the recipient partner. So this would be the fair market value of the asset, because whatever is the sale consideration which has been considered in the hands of the firm while calculating the capital gains in the hands of the recipient partner, that would be considered as the cost of the capital asset to the partner. Then definition of reconstitution of specified reconstitution, specified entity and specified person, as we have discussed. This was not there under section 45(4), because in the erstwhile section 45(4), it only talked about retirement or otherwise, and there was no proper definition which was provided, and most of it, the inferences were drawn from the judicial precedents. But now under the new law, it has been properly explained. Then CBDT, we would be discussing about the rules which have been introduced. There are rules which have been introduced by CBDT, so we would be discussing about that. Now, let us, for better clarity, let us start discussing about the case studies. Before that, I would just pause in a bit if there are any queries in the chat box. So I can see certain queries in the chat box. Probably once we discuss these case studies, I think those queries would be answered. Otherwise, if not answered, I will definitely take it up again. So let us start with case study one. There are two partners, A and B, in a firm ZX, having half share each. So both the partners A and B have half share in the firm ZX. Each partner has a capital balance of 100 in the firm. So whenever the firm was there and partner A and partner B had introduced their capital, both of them had introduced for half share in the firm, for 50% share in the firm. They had introduced 100 rupees in the firm. Both of them, A had come in with 100 rupees and B also had come in with 100 rupees. And resultantly, they had utilized this 200 rupees for purchase of assets, land A, which was for 100 rupees, and land B, which is also for 100 rupees. So this is the factual position in this particular case study. Now, after 5 years, two partners are admitted, C and D, who bring in capital of rupees 1,000 each. So with A and B, who were earlier having 50% share in the partnership, now C and D have also been introduced into the partnership. C has been introduced with a 40% share, D also has 40%. Resultantly, A's share has been reduced to 10% and B's share has also been reduced to 10%. Now, C and D at the time of their admission have brought in 1100 rupees each into the partnership firm. So after them means partner C and partner D being introduced into the partnership firm, the balance sheet position would be as it is now. So it will have capital of 2400 and assets of 2400. Assets, the bifurcation would be land A is of 100, land B is of 100, which was purchased earlier only, and the remaining whatever cash balance has been brought in by C and D is parked in cash, which is 2200. Now, with that, there is one more aspect which has to be considered, is that the fair market value of land A and land B at the time of admission of C and D partner is 800 and 1400 respectively. So land A, while when it was purchased, was for rupees 100, but later on when the new partners are admitted, the fair market value is 800. Similarly, land B, the book value is 100 and the fair market value is 1400. So simple figures have been taken for ease of understanding. Now, first is that at the time of this reconstitution, whether there would be any applicability of section 45(4) or section 9B. So this is a very simple example. Two new partners have been introduced. Now we first look at section 45(4). Section 45(4) says that the partner, the specified person, should be in receipt of cash or capital asset. Now in this particular example, neither A nor B is receiving any cash or capital asset. Similarly, so section 45(4) would not be applicable. Similarly, section 9B also would not be applicable because there is no receipt of any capital asset by the partners, by the existing partners, or there is no receipt of stock in trade by the existing partners. The existing partners have not taken back home anything. Their share remains, their capital contribution remains as it is. It is just that the new partners, at the time of their introduction, have brought in cash. So at this point, there would not be any applicability of section 45(4) and Section 9B. Now we further take this particular case study and say that what if A and B withdrew cash of rupees 1,000 each, leading to debit balance of their capital account. So what in the earlier query, the A and B partners who were there in the partnership firm did not withdraw anything, but what if they withdraw 1,100 each? Whatever they withdraw a certain amount of cash. So what would be the position? Now in this case, let us again start applying Section 45(4). Now since the cash has been withdrawn by A and by B, then there would be taxability under Section 45(4). Now there is reconstitution. Definitely there is reconstitution because there is admission of new partners C and D into the firm, and there is receipt of cash by the partners. So there is transfer of cash by the partners to the partners by the partnership firm ZX. So there would be applicability and there would be taxability under Section 45(4) for that matter. Now this only talks about cash. So what they have withdrawn is only cash. They have not withdrawn any capital asset. So there would not be any applicability of Section 9B in such a scenario. Now, again, making certain changes in the factual position, C and D are outsiders who provide loan of 100 each to the firm ZX. So C and D in the earlier scenario were inducted as partners, but now in this scenario, they are not inducted as partners and they have simply given loan to the firm. They have given a loan of 1,100 each to the firm. The position as is remains the same as was there in the earlier case. Now also whether we will have to look at whether there would be applicability of Section 45(4) and 9B. Since nothing has changed, so there would not be any applicability of both Section 45(4) and 9B. And also there is no reconstitution. So one more aspect which has to be considered is that there has to be change in connection with the reconstitution. But there is no reconstitution which has taken place because A and B were partners earlier, and now also subsequent to this transaction having taken place, A and B are partners. So essentially there is no reconstitution of the firm which has taken place. So there would not be applicability of both the sections. Now what if A and B withdraw this 1,000 rupees? So in this earlier scenario, they were just loan which had been received from C and D, and A and B did not withdraw anything over and above their capital balance. But in this scenario, they start withdrawing over and above their capital balance, resulting into them having debit balance of 1,000 each. So what would be the applicability of Section 45(4) and 9B? Still in this scenario, there would not be any applicability of 45(4) and 9B because as I mentioned that both the sections are applicable in connection with the reconstitution of the partnership firm or the specified entity. Whereas in this case, C and D have been taken, loan has been taken from C and D. They have not been introduced as partners in the firm. Neither there is any shareholding, there is any profit sharing ratio change between A and B. So there would not be any applicability of 45(4) and 9B. Now again, C and D become partners and their loan amount is converted into capital balance. So now earlier when they were simply providing loan amount to the partnership firm. Now in this scenario, in this case study, their loan amount has been converted into a capital balance. Now we would have to freshly look at the applicability of 45(4). There would be applicability of 45(4) because there is a reconstitution of the firm, because there is admission of partner C and D. So because of this reconstitution of the partnership firm, there would be 45(4) applicability. And with this reconstitution of the firm, there is also transfer of cash to A and B, because A and B have withdrawn more than their capital balance. So there would be applicability of 45(4) in this scenario. So we have now discussed that when there is applicability of section 45(4), under what scenarios there is applicability of section 45(4). One major important thing which has to be looked at is there has to be reconstitution of the partnership firm. And second important aspect which has to be looked at is that the capital asset or stock in trade or money has to be received by the specified person. Then there would be applicability. Now, once there is applicability, then there one also has to look at the mode of computation under section 48. And 48, there has been an amendment by the same Finance Act 2021, which says that, which talks about attribution. This is a new concept which has been introduced, and this, I think, rather than discussing about the section, we must straight away discuss about the case law in this. So I'm skipping section 48. We would be discussing section 48 with the case law. Then there is Rule 8AA, which has been introduced, which talks about the capital gains, whether it is a short-term capital gain or a long-term capital gain in case of applicability of section 45(4). Then 8AB rule has also been introduced, which talks about the attribution. Now, I think before discussing 48, the amendment which has been brought about in section 48, and both Rule 8AA and 8AB, let us first discuss about this case study, and then I think it would be much more clearer. Now, this is another case study which says that there are three partners, A, B, and C in the firm FR. And all the three partners have equal share, that is 1/3 share each. And all the three partners have capital balance of 10 lakhs in the firm. So consider this balance sheet position that partner A, B, and C have capital contribution of rupees 10 lakhs each. And there is simultaneously, when this capital was introduced into the firm, they had purchased land S, T, and U. And the book value of the land of all the three lands is 10 lakhs each. So on one hand, there is capital contribution of 30 lakhs by the partners, and on the other hand, there is capital asset in the form of land of S, T, and U of rupees 10 lakhs each. Now, this was at the time and it was purchased by the firm. Today, if we talk about the fair market value, land S, which had the book value of 10, has a fair market value of 70. Similarly, land T, which had a book value of 10, has a fair market value of 70. And U has a book value of 10 with a fair market value of 50. Now, let us just presume, for the sake of understanding the entire scenario, that the indexed cost of acquisition of land U is 15 lakhs. I would be discussing the relevance of this indexed cost of acquisition, but let us first assume that land U's indexed cost of acquisition is 15 lakhs. Now, land S, T, and U was purchased 2 years back. So these were all purchased 2 years back. Now we come to a scenario that partner A wishes to exit from the partnership firm. Now, if partner A wants to exit, and it has been decided between the partners that on exit of Mr. A, the partner, the firm decides to give him two things. One is 11 lakhs in cash, and second is land U to settle his capital. And so one part of the transaction is that we will have to find out the taxability when partner A receives 11 lakhs in cash and land U to be settled to him. There is one more aspect, that subsequently land S is also sold by the firm after 2 years. So after a span of 2 years from this reconstitution, land S is also sold by the firm. And land S is sold at 100 lakhs, and the indexed cost of acquisition is, say, 25 lakhs. Now we, with this given factual position, let us work out the taxability. In this scenario, as I've mentioned, that both cash is given to Mr. A as well as capital asset is given to Mr. A, then in that case, there would be taxability under 45(4). Simultaneously, there would be taxability under Section 9B. Now, first the question arises whether 45(4) is to be applied first or 9B is to be applied first. So first the treatment has to be of 9B, and then the treatment has to be given of Section 45(4). And in fact, this has been clarified through the rules also, Rule 8AB, which we discussed. This example is from that rule, so it has been clarified as to how the taxability or how the computation mechanism would work. Now, first we will find out the taxability under Section 9B. 9B would be invoked as the capital asset is transferred to the partner A, but it would not be invoked if cash is paid, because as I mentioned in the beginning, 9B is only applicable if the capital asset is given. It does not talk about cash. It only talks about capital asset or stock in trade. Whereas 45(4) talks about the capital asset as well as cash. So in this case, since 9B doesn't talk about cash, there would not be any computation with reference to the cash paid of 11 lakhs. Now we calculate the capital gains as per Section 9B. What is the sale consideration? Sale consideration is 50 lakhs. 50 lakhs is, so land U is given. Land U is given to the partner A on his exit. Now, sale consideration for the computation purposes of Section 9B is the fair market value of the land. And fair market value we discussed in the beginning was 50 lakhs. So 50 lakhs is to be taken as the sale consideration. Indexed cost of acquisition we had already assumed was 15 lakhs. So the long-term capital gain in this case would come to 35 lakhs. And tax on this long-term capital gain would come to 7 lakhs. Let us assume a 20% base rate, so 7 lakhs. So this is all about 9B. Now we again come to Section 45(4). Now, first of all, we will have to give impact of this computation under Section 9B while computing for 45(4), because one will have to consider the capital balance of the partner who is exiting, which is Mr. A. Now, if we find out the net profit in the books of accounts, this would be fair market value 50 rupees. The book value of that land which is being given to partner A is 10. And long-term capital gain tax which has been given is 7. So ultimately, the net profit after tax in the books of the partnership firm would be 33 lakhs, which would be 50 lakhs of sale consideration or the fair market value which is considered, and minus the book value which is 10 lakhs and minus the tax on LTCG. So 33 lakhs is essentially the net profit which is calculated for the purpose of books of accounts. Under Section 9B, what we had calculated was calculation for the purpose of capital gains. But we first, for 45(4), because we have to arrive at a capital balance of Mr. A, we will have to first find out what is the impact in the regular books of accounts of the partnership firm. So the net profit after tax in the books of the partnership firm comes to rupees 33 lakhs. This 33 lakhs is the profit which would be distributed amongst all the partners, and this would be distributed even to partner A. So his capital balance earlier was 10 lakh rupees. His share in the net profit is 11 lakh rupees, and the capital balance on the date of his retirement is 21 lakh rupees. So essentially what we have done is, on one hand, we have considered the capital asset to have been given to a particular person, which happens to be partner A. We have calculated the capital gains based on Section 9B by giving effect to the indexed cost of acquisition, the fair market value of that land. That impact in the books of accounts has been taken while calculating the balance of the capital account of partner A. So because 33 lakhs was the net profit in the books of accounts of the partnership firm, this 33 lakhs has been distributed to all the partners, including partner A. So because of this distribution, the earlier opening balance of the capital account of partner A was 10 lakh rupees. Thereafter, he got a share of 11 lakh rupees. So capital balance was 21 lakh rupees. Against this 21 lakh rupees, whatever he has got, now this 21 lakh rupees is nothing but the balance in the capital account of the partner. This would be the D element of the entire transaction. The B element is, as we discussed, is the cash which has been given to the partner. This is 11 lakhs. And C is the land which has been given to the partner. So there is taxability of this land having been given both under 9D as well as under section 45(4). So we will have to come out with the amount which is taxable under 45(4), which would be 11 lakhs. That is the cash which is given to the partner, plus the partner A which is exiting, plus 50 lakhs, which is the fair market value of the land which is given, and minus the capital balance in the partner's account, which is 21 lakhs. So net amount is 40 lakhs, which has been given to the partner. And essentially, there would be taxability of this 40 lakhs under section 45(4). Now, what has been done in this scenario? One will need to understand that what are we trying to achieve in this. What we have done is that because we have given certain extra amount to A, this extra amount to A has been given to him by virtue of the increase in the valuation of the remaining assets. Because since A is exiting from the partnership firm, and once A is exiting from the partnership firm, apart from land U, he also has certain ownership to land S and T, which remains with the partnership firm only. Now, since he has been given more than whatever capital balance he has got, so essentially this is an additional amount which has been given, which represents nothing but the increase in the valuation of the assets which remain in the partnership firm even after his exit. So that has been also considered under section 45(4). And this is what the attribution which we talked about is. Because this additional amount which has been given, this additional amount, the tax which has been given under section 45(4) at the time of his exit, this would then be attributed to the remaining assets in the partnership firm. Now, after A's exit, since land U has been given to the partner A, so S and T would be remaining. Now, suppose the fair market value of that land, both the lands, is 70 lakhs each. So there is a valuation gain of 60 lakhs. And on that, this 20 lakhs additional amount, which has been 40 lakhs additional tax, which has been given, which has been considered under 45(4), that 40 lakhs would be attributed to the remaining land S and T. So the land S, because this 40 lakhs has been given, the tax has been given at the time of exit, and this is nothing but the tax which has been paid on increase in the valuation of land S and T at the time of exit of partner A. So this 40 lakhs is nothing but prepayment of the tax liability. So since 40 lakhs, they will then have to be attributed to the remaining land S and T. So there is a formula which has been provided under Rule 8 AB. AB, which says that the attribution has to be on the basis of the revalued assets, revalued value of the assets. So this 40 lakhs will be attributed to S and T in the ratio of 50-50%. So 20 lakhs would be attributed to S and 20 lakhs would be attributed to D. T, which is charged as long-term capital gain at the time of exit of A only. Now, if suppose tomorrow land S is sold, when tomorrow land S is sold, and we discussed earlier that land S is sold at a value of say 100. So this 100 is the sale consideration minus the cost of acquisition which has been assumed, which is 25. And we will also, this is very, very important, that whatever attribution has been done to this capital asset S, because this 20 lakhs tax on this 20 lakhs has already been paid at the time of exit of Mr. A. So this attribution will have to be reduced because the firm has already paid tax on this particular 20 lakh at the time of Mr. A's exit. So this will have to be reduced. And on the balance 55 lakhs, the long-term capital gain will have to be calculated. Now, there is when this section was introduced, there was a lot of apprehension amongst the practitioners that this would amount to double taxation of the same transaction. No, it is not a double taxation. What essentially the section wants to do is to whatever additional amount at the time of the exit of Mr. A has been given to Mr. A, this is nothing but which is attributed to the increase in the value of that lands which have remained with the partnership firm even after the retirement of Mr. A. So essentially what they are trying to do is to tax that amount, tax that increased amount at the time of exit of Mr. A only. So this is nothing but preponement of the tax liability. Essentially, if the tax has been paid in at the time of exit and subsequently after 2 years, if the land has been sold, which attribution had already been done, so this is reduced from the cost of the sale consideration to arrive at the long-term capital gain. So essentially, 20 lakhs, the tax has already been paid at the time of exit of Mr. A. So we are not again paying tax on that, and we are only paying tax on the balance amount of rupees 55 lakhs when land S was ultimately sold. Now, for this, just last, I wanted to convey one more thing, that whenever there is attribution or whenever there is applicability of section 45(4), one must take into account that a form has to be filed with the income tax department, that is form 5C for attribution, and that has to be filed before the filing of before the due date of filing of return under section 139(1). So whenever there is simultaneous application of section 45(4) and 9B, then one must make it a point that one files form 5C before the due date of filing the return of income. This was in fact the first agenda which we wanted to discuss. Now we will briefly touch upon, because we don't have much of time, we will briefly touch upon the conversion, the next agenda, which is conversion of a company into LLP. Company, there is a whole lot of difference between a company and a LLP. I will not be discussing this in greater detail. One important distinguishing factor is that the applicable tax rates, in case of a company, the tax rates range from 25%. It is also in case of 115B, 15% base tax rate. In case of an LLP, it is approximately 34%, 30% plus the surcharge and cess. So the tax rate is different. There is one important change, which is the taxability on distribution of profits. In case of a company, whenever profits are distributed, there is taxability in the hands of the shareholders, whereas in case of a partnership firm or a LLP, when profits are distributed, there is no taxability in the hands of the partner. So essentially, the company follows a two-tier taxation system, whereas in case of an LLP, there is only one-tier taxation system, one may say, because in case of a company, the corporate tax is paid by the company at the time of earning the profits, and thereafter at the time of distribution of those profits, the tax is paid, whereas the LLP only pays tax at the time of earning the profits, and thereafter when the profits are distributed amongst the partners, no further tax is paid. Then, of course, there is deemed dividend, which is applicable in case of a company, which is not there in case of a limited liability partnership firm. So essentially, there are a lot of reasons why a company would want to convert itself into an LLP, because it might help in efficient tax extraction from the LLP. There is also no issue of deemed dividend in case of an LLP. So essentially, those companies which are into small and medium scale businesses having a lot of inflow of cash can think of converting themselves into LLP. Now, conversion of a company into LLP is not a transfer, is not considered as a transfer under Section 47 if the conditions which are prescribed under Section 47 and the clause which is essentially applicable is clause 13b. So one would have to look at whenever a conversion is taking place, one would have to look at the applicability of the conditions, whether the conditions as prescribed under clause 13b of Section 47 has been fulfilled or not. I would not be discussing in greater detail those conditions, but one will have to look into those conditions very carefully. Now, what if the conditions are not fulfilled? Then, if at all those conditions are not fulfilled, then one will have to consider the decision of Celerity Power LLP of ITD Mumbai bench, which says that if the conditions are not fulfilled, then it would be considered as a transfer. So whenever a company is being converted into an LLP, one would have to carefully consider the conditions as prescribed under 4713b. If those conditions are not fulfilled, then it would be considered as a transfer, and that may entail taxability in the hands of the partnership firm as well as in the hands of the partners, in the hands of the shareholders, and in the hands of the company or the newly converted LLP. As far as the depreciation, because whenever if the conditions of 4713b are fulfilled, then life is much simpler. There is no taxability in the hands of the company. There is no taxability in the hands of the shareholders. They can very well become partners in the LLP, where if there are unabsorbed depreciation, brought forward losses, that can be easily carried forward. But that is only possible, this carry forward is only possible once those conditions are fulfilled. If those conditions are not fulfilled, then there is no there is taxability, and this conversion would be taxable, and the partners, the shareholders, will have to pay tax. There is also applicability of Section 47A, because if the conditions, because in the conditions there are certain other conditions which are prescribed. One of the condition is that the whatever amount is there in the partnership as part of the accumulated profits in the company after conversion, that cannot be taken out by the partners for 3 years. So all these conditions have to be fulfilled. So if those conditions are not fulfilled and midway there is profit extraction by the partners, then whatever conditions were there through which 4713b got applicable and transfer, this conversion was not considered as a transfer. And subsequently, if those conditions are not fulfilled, then it would be considered as a transfer. And whatever taxability had not arisen at the time of conversion, the taxability would arise in the year in which those conditions are not fulfilled. So one has to be very careful of that. Another important aspect is the applicability of Section 43CA, because there is, if suppose there is a company and the company has a capital asset as part of as an immovable property as part of stock and trade, and when it is getting converted into LLP, one also has to consider the applicability of Section 43CA. essentially, if you look at the subsection 1 of section 43 CA, which says that consideration received or accruing as a result of transfer by assessee of a capital asset. So one may argue that there is no consideration received or is accrued whenever there is conversion from a company into LLP, and hence there would not be any applicability of section 43 CA in that. Of course, one will have to also look at the GAR provisions. Of course, the threshold is 3 crores for any applicability of GAR, but one will have to look at. So, if the sole reason of conversion of a company into LLP is to avoid tax, then there can be an applicability of GAR. But in fact, the argument against the applicability of the GAR can be that since there is a specific section only which has been provided, which recognizes a conversion of a company into LLP as a non-taxable conversion, so there should not be any applicability of GAR. But of course, one will have to also, look at the commercial substance of the transaction and all these things before undertaking any conversion. Now, one of the conditions under section 4713B was that the gross receipts and turnover has to be up to a particular limit. Now, what is gross receipts and turnover has been provided by the CBDT in Circular 1 of 2011, which says that whatever the gross receipts or turnover which is taxable under the head profits and gains of business and profession has to be taken. Next question is, what is the impact of the MAT credit for post conversion? So LLP cannot utilize the MAT credit. Then whether it is necessary to remove charge on the assets? Yes, as per the third schedule, if suppose there is a company and a company is getting converted into a limited liability partnership firm, and a charge has already been created on the assets of the company. So prior to that conversion, the charges have to be removed, which is a specific requirement under third schedule. So one will have to also consider that. Whether the LLP has to renegotiate the existing contracts, there is no requirement of renegotiating the existing contracts, because as per the third schedule of the LLP Act, through which the conversion takes place, it says that all the existing agreements in the company shall be substituted with reference to the LLP. So the converted entity need not enter into a fresh agreement. Now, conversion of a firm into company is almost on the same lines because there is paucity of time. I'm not discussing this in detail, but similar to a conversion of a company into LLP, which is not considered as a transfer as per section 47 clause 13B, if the conditions are fulfilled. Similar to that, if a firm is being converted into a company, then the one will have to consider the conditions of section 47 clause 13, and if those conditions are fulfilled, then there would not be any taxability. I am not discussing why a firm would get converted into a company. There may be different reasons for that. There can be because the firm, in case of a partnership firm, there cannot be a foreign direct investment, but in case of a company, there can be foreign direct investment. Also, because of the changes in the tax rates, and companies end up paying lower tax, so there can be certain tax benefits. But as I mentioned, only tax benefits should not be the reason of this conversion. There has to be some other rationale also of converting a company into LLP or a firm into a company. Then last of the agenda which we would be discussing is capital contribution by partner to the firm or LLP. This is governed by Section 45, and this would be just last 5 minutes I would be devoting on that. This is the last part of our discussion points today. There is Section 45 subsection 3, which comes into force whenever there is transfer of capital asset by a partner to a firm. So whenever a partner is being whenever a person is being inducted into the partnership, or a existing partner introduces a capital asset into the partnership firm, there is applicability of 45 subsection 3. Now, this section was introduced by Finance Act 1987. Now, prior to that, what legal position was there was in Supreme Court decision in Sunil Siddharth Bhai, which said that there is, whenever any capital asset is being contributed by a partner to the partnership firm, there is no flow of actual consideration, because the partner's capital account has been credited, so there is no actual consideration which is accrued or received at the time of transfer of capital asset by a partner. So essentially, the computation mechanism failed because the consideration leg of the transaction was not there. So to change this, amendment was introduced, and this section was introduced which deemed that whatever amount is recorded in the books of accounts of the partnership firm, that would be considered as the deemed value of consideration. So there is a deeming fiction attached to Section 45(3). So if suppose there is a partner A, and if he wants to introduce a capital asset, say of 1,000 rupees, and the fair market, and this asset is recorded in the books of accounts at say 1,200 rupees. So this 1,200 rupees would be considered as the deemed value of consideration for the purpose of computing capital gains in the hands of the partner. So there is a deeming fiction attached to it. Now, one controversy which I wanted to discuss was whether 45(3) would be applicable, or whether it would be overridden by Section 50C in case the capital asset is an immovable property. So for instance, if a partner is introducing a capital asset which suppose say is a land, an immovable property, into a partnership firm, and for instance the market value of that, or the value at which it is transferred, or it is the capital account is credited of the partner is say 1 lakh rupees. However, the fair market value of that land is 1,50,000 rupees. So the question is whether the capital gains would be calculated in the hands of the partner with reference to 1 lakh rupees, the amount which has been credited in the capital account of the partner, or it would be at 1,50,000 rupees, which is the actual DLC rate or the circle rate of that property. Now, this 50C is applicable, makes this 1,50,000 relevant, because 50C, whenever any capital gain is calculated, then 50C value has to be determined. So the question arises whether for the purpose of Section 45(3), one will have to look at Section 50C. Now, there are two views which are possible. One says that you don't have to look at 1,50,000 as the sale consideration. You just have to look at rupees 1 lakh, the value at which the asset has been, the books of accounts has been credited, or the capital account has been credited, and one will have to ignore or not look at 1,50,000. The other view is that 45(3) cannot override 50C, and 50C will always be applicable. So both the views are possible, but there are arguments for both the views. But clearly 45(3) would override 50C. This has also been upheld by various decisions, and there is a favorable decision of Network Construction Company 185 ITD 318 of Mumbai Tribunal, and also Allahabad High Court decision in Carlton Hotel, which one needs to consider. So the possible view is that one will have to look at the value at which the capital account is credited and not the value which is with reference to the DLC value of the property. The other important aspect is the applicability of section 56 to 10 in such a scenario whenever any capital asset is introduced into the partnership firm. So whether if the value at which it is recorded in the books of accounts is lower than the fair market value of that capital asset, then whether there would be applicability of 56 to 10 in the hands of the partners or in the hands of the partnership firm. So in either case, the view is that it would not be applicable because essentially the partners who are there in the partnership firm, the asset which is received is not by the partners but by the partnership firm. So partners of the partnership firm would get out of that purview. Now the next question is whether there would be applicability of 56 to 10 in the hands of the partnership firm. So there also it would not be applicable, and there is a direct decision in the case of Shelekha Business Consultancy Private Limited, 121 taxman.com 150. This was in a scenario prior to 56 to 10 when section 56 to 7A was there in force. In that, it was held that if the capital asset is introduced into the partnership firm at a value lower than the fair market value, then there would not be applicability of 56 to 7A as far as the partnership firm is concerned. And there were reasons to it. First is that the receipt of a capital contribution by a partner from a partner into the partnership firm is on a capital field and not on the revenue field, and amount which is credited in the capital account cannot be equated with the consideration, and since the consideration is not determinate, the computation mechanism fails. So on these three counts it was held that there cannot be applicability of 56 to 7A. So we come to the last part, the queries. I understand that there are certain queries which have been there in the Q&A and chat box. I hope in the Q&A it has been. So it says that. So in the example, if A and B withdraw the cash more than the balance in the capital account, but there is no change in the profit sharing ratio or capital ratio, will it be taxable in the hands of A and B? No, it would not be taxable because there would only 45(4) would be applicable, and 45(4) would be applicable only in a scenario when there is change in the there is reconstitution of the partnership firm. Unless there is reconstitution of the partnership firm, there cannot be any taxability in the hands of A and B. 45(4) applicable at the time of receipt, withdrawal of cash, or at the time of conversion of loan to capital. So it is only at the time of withdrawal of cash. It is not applicable at the time of conversion. A reconstitution means change of P&L sharing ratio, correct? Yes, the reconstitution, the meaning of reconstitution for the purpose of 45(4) and 9B has been defined under section 9B only, as I mentioned. So one will have to look at the definition, look at the meaning of reconstitution under 9B. In reconstitution, if amount is received directly from the new partner and not from the firm, then will 9B or 45(4) apply? Essentially, whenever there is any such reconstitution, so it has to be through the partnership firm only. So even if direct amount has been given, the effect will have to be given to the in the books of accounts of the partnership firm. So essentially, in that case also 9B and 45(4) would be applicable. So there is one more. There are a few other queries which have been raised. If the new partner brings in capital, what is the taxability in cash? So whenever a new partner brings in capital, the only taxability is as per section 45, subsection 3, as we discussed. And if suppose cash is being contributed. So 1 lakh rupees is being contributed by a incoming partner. So his capital account would be credited with 1 lakh rupees only. So essentially, there would not be any taxability whenever there is cash introduction. So essentially, we have covered most of the things. If there are any other queries, would be happy to answer those queries, and one can connect with me directly and would be happy to answer the queries on a one-on-one basis. As far as this presentation is concerned, I've touched upon all the issues which we wanted to at the start of the this webinar. Thank you from my side.